very important. Is Masaya Hirano. I'm really very sorry. I totally forgot to introduce him. Very nice timing. And I would like to give the mic to him. And let's get started.
All right. Hello, everyone, and thank you very much for your very kind introduction. My name is Masaya Hirano. I am a Japan and the state of New York qualified lawyer. I am a corporate and commercial partner at TMI Associates, which is one of the largest business law firms in Japan. Okay, so it is my great honor to be here tonight with 4 distinguished speakers from the Valley practitioners to explore the story behind M&As of early-stage startups. As a practicing lawyer, my expertise lies in corporate finance, mergers and acquisitions, venture capital investments, ranging from established companies to emerging venture companies all over the world. So let me briefly explain or introduce about my background. For the past several years, my practice has been heavily weighted in the technology sector, for example, social media, big data, software, cloud, and data storage, as well as life sciences and so on. I've been assisting Silicon Valley companies to get into the Japanese market, from setting up companies, as well as adjusting, localizing for business model in Japan. Also, interestingly, for the past several months or so, I've been assisting Japanese venture companies investing outside Japan, from Israel, India, and also, of course, the United States. So from my experience, all of the transactions have similar characteristic in a way that they follow Silicon Valley practice with some local flavor. There are differences, however. As you may know, under the Abenomics and the Japan Revitalization Strategy 2014, the Japanese government has been trying to develop an ecosystem where business launches, spin-offs, and carve-outs from large companies and mergers and acquisitions of venture businesses are encouraged to drive growth areas. However, in Japan, M&As has been used as an exit option just as about 60% of all the transactions from 2009 and 2013, as opposed to the US, which was about 90% during the same period. M&As are the vast majority of exit routes for investors in early-stage startups in the United States, but it has not been that much in Japan. So tonight, as a Japanese practitioner involved in Silicon Valley transactions, I am very much looking forward to listening to the stories behind this practice from the distinguished 4 speakers, which in its nature will not be otherwise publicly available. So during the course of this discussion, I'm sure that you may have some comments or questions to pose to the speakers and perhaps to myself, and we welcome them. However, in order to save time, we would appreciate if we could take the questions at the very last end of this session. So, Nobu-san, thank you very much. I'd like to move on to my keynote presentation first, and as part of this, as I have already mentioned, about M&As of early-stage startups. Let's begin with an overview. This chart is based on the National Venture Capital Association Yearbook 2014. And what you can tell from this chart is that, as you can see from the right side down, this kind of shape, it's a trend that the IPOs have been the major way of exit in the 80s and 90s up until around 2000 in the US. As this red arrow shows, M&As has gradually increased its presence and has taken over the majority since around 2000. Now, as I mentioned earlier, almost 90% of exits are made through M&As, as previously mentioned. Okay, can I go on to the next slide, please? So this slide, yeah. Okay. So the next slide would show some percentages. Okay, from the year 2012 and 13, 71% of tech startups experienced exit before Series B financing. Technology. And it was 40%, again 44% in 2014. So still, early stage startup companies are using M&As as a way of exit. So one of my interests as a Japanese practitioner, and again, is what are the key factors for M&As of early stage startups, and whether we, from Japan, can expect similar things to happen in the future. It could be the development of how to value early stage startups without having the shares being listed on the stock market, or the way to keep the founders motivated to stay with the company even after the acquisition, or any other factors. So, in light of these interesting facts and figures, I'd like to now pass on to my speakers, give some keynote speeches based on their specialties and interests tonight. So, could I start with Chad, please? Could you speak a little bit about on your background and also tell us your interest within 3 to 5 minutes, please?
Yeah, sure, absolutely. So, as I mentioned, I specialize in valuation, and I would say at least once a week I get the question of how do you value a startup, and so I think I'm going to focus on that for this evening. And I hate to disappoint people, but there is no one great answer. It's going to be more about a thought process or a framework to think about valuation. And maybe to best exemplify how you think about value, I think about all the news today that you read. For every article I read about there being an internet bubble, like there was back in 99, 2000, and by the way, back then I was a day trader, so I experienced that bubble. I was born, the bubble crashed, so it was not a great time for me. But for every article you read about the bubble, you read another article about how hot the M&A and IPO market is. And so the question is do you pay to play and be part of that, or do you sort of sit on the sidelines because you think there's a bubble? And I think no matter what the reason for an acquisition is, so my clients will make acquisitions from everything from an acqui-hire need, so really just buying the talent for the company, to a tuck-in for tech, to expanding their market share. But the framework for those investments are relatively the same. It's first of all thinking of what's your business case for the investment. And it starts, I'll start from the inside and go out, but it doesn't really matter where you start. I think what matters more is that you think about these factors. So first of all is, who are you buying? Like if it's a startup company, I think the founders and their background is very important. What is their history of success? Who is the management team that they built around them? What are their immediate hurdles? Is it a financing? That's scary.
Can you move the mic a little closer to you?
Yeah, absolutely. Sorry.
Thank you.
Is this better? All right.
Yeah.
Okay. So going on. So what is the business case? So again, it's the starting with the founders and the team that they built around them, and then you go on to what is the market they're going after, and think about what kind of how they define the market, what kind of market share do they think they will get, and then what's the competitive landscape? Who are they going up against, or is it really just a new market entirely, or is it a completely disruptive force where they're creating a new market? And lastly, but maybe most importantly, what is the risk, right? So failed deals is not around necessarily paying too much or too little relative to what you think is worth. It's mispricing risk. So if there's a lot of risk there, you want to make sure that you fully encapsulate that in the approach that you value in a company. So that takes me to maybe my second point is, how do you value a company? And maybe that's maybe where I first started, but there's really 3, I'll call it, key models for valuing a company. And when I say a company, I really mean a company is nothing more than a collection of assets. So it's a company, it's a particular asset, it's IP, it can be a factory. And so just real quickly, those approaches are the income approach, market approach and the cost approach. And I won't get into the financial theory behind them, but maybe just touch upon what some of the key inputs are. For an income approach, at its basic, it's forecasting what the future growth are, and then capturing the risk or the volatility or the uncertainty in the future cash flows. The market approach is really just the same thing, and it encapsulates the same sort of the parameters that you're thinking about. It's the future outlook and the risk. So instead of forecasting out cash flows and bring it back into today's dollars to capture the uncertainty, it's sort of doing the opposite. It's taking today's results and forecasting it into the future through some valuation metric. And the last approach is the cost approach. It's usually the approach of last resort. And it's really just coming up with a cost to recreate the asset or the business with similar functionality and utilization. And with those three approaches, and there's derivations of each one of those, but with those three key approaches, you can really tackle any company, no matter what stage of investment it is. The challenge will be, though, obviously, the earlier stage it is, the less information you have, and so maybe the more qualitative overlay you have on top of that analysis. Again, those models will come up with an intrinsic value. And by intrinsic value, I mean what's the value to sort of an investor today based on the future outlook. What it doesn't necessarily capture is sort of what is this worth to someone else at some point in time. An example would be, I remember just 6 months ago we were talking through the valuation of WhatsApp, and through internal models we were like, we could barely get to a valuation of, call it, $3 to $4 billion. And I was like, there's no way this thing's worth $4 billion. It was like, obviously y'all know, it was sold a couple months later, $18 billion. And you know what? And the market reacted favorably to that acquisition. And so if Facebook didn't make that acquisition, would it have been sold to someone else for something close to $18 billion? And there's no good answer to that. But my sense is that sometimes you just get that one key player who's going to drive up the price, and then everyone else is going to look at that, and they're going to be priced off of a similar multiple or a similar sort of sentiment. And so you're sort of like a rising tide lifts all ships, and I think that's what we're seeing, is that there's a lot of excitement around the technology, around social media or IP, and so you've got a lot of sort of exuberance around those values, and we can talk more later about how we sort of price that into the income, market, or cost approach.
So, shall we move on to Dennis? Sure. About 3 to 5 minutes, please.
Sure, it's a lot to cover on a topic like this, but I think one of the key things that I think a early stage M&A is a lot different than a traditional M&A is at the beginning. Clearly, it does sometimes take a long time to agree on valuation. As Chad mentioned, there's not one easy way to do it. If you've got a company that's been around a while, it's got audited financial statements, there's usually some metrics, some multiple of EBITDA or some other factor you can easily value. Here, it's about a technology fit. The buyer is looking to get a solution, either hiring talent, and again, in most parts of the country, talent maybe is $1 million an engineer. In the Valley here, it's $1.5 million, maybe $2 million, and even going higher. And so it's really hard to use one metrics to figure that out. And so early on in some of the due diligence, it's really difficult to see if there is a technology fit. Of course, the buyer wants to see everything that the seller has. They want to see their patents, want to see what they have in process, their trade secrets and everything. And of course, the seller doesn't want to show them anything. And so how do you get a meeting of the minds? Is this technology really fit? And a lot of times, they're already a strategic partner, already a competitor, they're already a customer. And so they do have some, small insight as to what's there. But you got to price in the risk. There's a lot of uncertainty. There isn't a huge patent portfolio like Intel has. I mean, they may have a few patents, they may have a few trade secrets, but not quite developed out. But at the end of the day, the big company's saying, hey, we need this technology, we need this talent. It's cheaper for us to pay $50 million now, or $100 million now, or $500 million now, than it is to pay 5 times that or 10 times that later. And so that's where you a lot of diligence. Not a lot of diligence to do up front. They usually don't have a lot of contracts, they don't have a lot of patents, they usually don't have a lot of information to go through. Certainly, a lot of them have audited financial statements, so there's a lot of uncertainty there. And it comes back to the management team, a lot of the factors that Chad talked about as to do that. Now, once you kind of get to a letter of intent stage, once you sign a term sheet, then the deal looks pretty much similar to every other deal that's done. The diligence may be a little bit different, but ultimately you have some negotiation, you sign a definitive contract, you have some closing conditions, and you close the deal, you get whatever approvals you need. But unlike more traditional tech M&A deals, there's a lot of times a dual track. You could either go public or you could sell. The early stage, unless you're in biotech, it's pretty hard to go public. I mean, no underwriter is going to take that company public in the U.S. So the only potential exit is M&A, and is now the right time for both sides, or is it later? And so that's where you have kind of that dance that's done between the buyer and the seller. The buyer wants to find out everything about the technology, everything about the personnel, they want to talk to everybody. And the seller's saying, well, no, let's sign a deal, we'll tell you at closing, trust us, that sort of stuff. And so you have that dance that goes on for sometimes months, sometimes years, sometimes weeks, and the deal's done. So that's one of the big differences between a traditional M&A deal and an early stage one, is the early part of the deal is a lot different. And sometimes they go very quickly. I mean, because one of the issues in the big companies, and maybe Greg will talk about this a little, is that you got to find a champion. But sometimes you need two champions. Sometimes the engineers love it, the scientists love it. This is great. This is perfect for us. But the business people say, we ain't going to pay that kind of money for that. You know, we have no interest in that. And so sometimes the business people who fail the tech and the science aren't excited because maybe they felt like they should have built it themselves. Or maybe that's what their bailiwick, and they should have come up with that invention rather than a third party. So sometimes the tension inside the buyer is difficult to get everyone saying, they got the board to approve it, and you got to get the business line to approve it, you got to get the managers to approve it, you got the tech and the science and a lot of people to approve it, where the entrepreneur startup, he's got two guys and a dog, and they all agree, and they're willing to sell for that price. And so that's some of the interesting stuff. I don't want to hog all the time, I'll pass the mic now.
Thank you, Dennis. We'll move on to Mitch-san. Can you make your keynote speech in 3 minutes, please?
Okay. Sure, you can just skip that one. And yeah, skip that one. Next slide. Oh yeah. So I don't know whether this one helped much, but anyway, this is a company called Swell, which we invested in a Series A, actually from a C stage in 2012, and the company was acquired by Apple last year. It was an interesting use case, so that's what I thought I brought it up here. The company has developed some the podcast recommendation app on the mobile phone, and they are serial entrepreneur, and they have sold the previous company to the Amazon before. And we have a very good investors come to this company, and we launched the service in 2013. And right about 1 year later, Apple acquired the company, and it's around that price ranges they acquired. So it was a good exit because we didn't lose money, but we didn't get exactly what we are hoping for. But in a way, it was a happy ending from an investor point of view as well, because we are having a, this is not easy market to target. So so we have finally something like this case just come out at the end, and the good things is that they're great engineers, so that the Apple just want to hire the people and the engineer, put the price on that. And next slide. So some of the key things, what we think happening on an early stage exit is one thing is a competitive market. There's so many people have so much money. People like Microsoft, Google, China Telecom, or even the Rakuten and SoftBank. Those guys has over like a $50 billion or $20 billion cash, and they're ready to buy anything nowadays. So those, and they have a high valuation company too. So they are very, very aggressive in terms of buying companies. And also, as a lot of people talking about the open innovation things, it's just so difficult to innovate some new idea rather than buy it. So that's the way a lot of people start thinking about it. So I think that's why there's more and more acquisition M&A is happening. The other thing is the engineering shortage, which I think Chad and Dennis talk about it. It's really hard to find quality engineers. So just acquire and put the 2 years to make sure you stay with the company, and give you a bonus after 2 years. I mean, that's the best way for the large company to maintain the quality engineer in the companies. And the last thing is actually this is not talked about too much, but I think it's important things is that what you can do with money has changed a lot. Previously, you need a lot of money to raise to buy an Oracle server and put the internet, the line, those kind of things. It's very expensive to start a company. Nowadays, it's so cheap to start a company. we used to think in 2004, a C-stage company is somebody who is building a prototype, and the Series A round is somebody start launching business. In 2014, people start talking about actually the C stage is already launching business, and Series A financing is to get traction. And now, even this year is even moving step ahead, is that at the C stage, you already have a products out and you already getting traction. And the Series A round is just expand the raising money to expand the business. So in a way, the company, startup company, what they can do with money is much more now. So that I think at the C stage, Series A stage, they already have a quality products in the market. That's how I see it. Thank you.
Thank you, Mitch-san. Finally, coming to Greg-san, could you share your topics with us, please?
Sure. So I guess the point I want to make is that, at least from my perspective, traditional M&A is different from tech M&A. So what you see in traditional M&A typically is a company in a business buying another company either in the same business or a closely related business. In traditional M&A, you also don't see many startups getting acquired. You tend to see a big company getting bought by a bigger company. So those are some things to kind of keep in mind. On my slide here, I have some examples. Supermarket chain buying another supermarket chain. The benefit being, efficiencies of scale, cost reduction, market consolidation, and as well as airline buying another airline. Next slide. In tech M&A, though, you tend to see something different. So, for example, in the first example I have here, you have an e-commerce company buying a robotics company. Two completely different businesses. But the robotics company is actually used in Amazon's logistics, which is why they bought it. And then the other examples here on the bottom are, with the Google example, that's an early stage startup that got bought. I think they were only around a year or two before they got acquired. Of course, they had, at the time, they were perceived to have almost 50% market share of their market. So, if you can get 50% market share of your market, somebody may want to buy you. The second example is a software company, a database company, basically buying a hardware company. So, these are different businesses. But in that case, there was a synergy because the Oracle software runs on some of the Sun software. And by buying the hardware platform, now they can sell an integrated unit to customers, and that presumably will increase efficiency, reliability, security. It'll also create additional client or customer stickiness, because it's harder now for customers to transition off of that platform. So I guess the other point I wanted to make is for IP compared to traditional M&A, IP is more of a main event. It's either one of the reasons you're doing the deal in tech M&A, or could be the main reason you're doing the deal. Whereas in traditional M&A, IP might be important, but it probably isn't a main event. So in traditional M&A, the deals you see, they're looking at things like, in terms of the target company, what assets do they own? What cash do they have? What real estate do they have? How many customers do they have? What kind of revenue do they have? You don't tend to see that as much. And in particular, if you're an early stage startup and the only thing you have is IP is going to be very important. And I guess the other point is IP issues for tech M&A deals, if that's your main value proposition. If you have problems with your IP, meaning you end up not owning it, or you've done something with it that the potential buyer is not going to like, that could be a problem. Now, it could be a major problem that kills the deal. It could be a minor problem that doesn't kill the deal, but it affects price. So just some thoughts. If you're working at a startup, you may want to think about what your exit strategy is going to be. What's my value proposition? How am I better than my competitors? If M&A is your liquidation event of choice, who's going to buy you? Why are they going to buy you, right? So you should give some thought to that. It shouldn't necessarily dominate your business operations, but that's something you should keep in mind. If you're working for a big company, I guess the thought is, what is your company's plan in terms of going forward? What's your strategy? What are you going to do? And
when you think about that, you should identify what do you need on a going forward basis, and are you going to build that, or are you going to buy that? And if you're going to buy that, then M&A is a tool you can use for that purpose.